The US dollar has held global dominance for nearly 8 decades, yet structural pressures on its supremacy are growing increasingly apparent. Despite unmatched liquidity and trust, the combination of unprecedented federal debt and persistent deficits signals that the foundation of dollar dominance is eroding beneath the surface. Since the 1970s, the dollar has functioned as the primary medium for global trade, finance, and reserves, benefiting from an entrenched network effect that no other currency could challenge. Yet the convergence of growing sovereign debt, expansive monetary policy, and negative real interest rates is quietly undermining the confidence that has historically sustained its supremacy. The paradox is stark. The dollar appears strong in global markets, yet the underlying economic fundamentals suggest systemic fragility. Negative yields, prolonged fiscal deficits, and an ever-expanding monetary base echo patterns that preceded previous major currency declines, warning of risks that history has repeatedly documented. Foreign central banks, once unwavering in their support of treasury securities, are now diversifying into euros, yuan, and gold. These portfolio shifts are subtle and gradual, yet they mirror the early stages of currency confidence erosion seen in previous global reserve transitions. U.S. sovereign debt has surpassed $33 trillion, representing over 120% of GDP, a level historically associated with constrained fiscal flexibility and rising default risk. When governments continually borrow, while the central bank prints money to finance deficits, inflationary pressure mounts, weakening both domestic purchasing power and global trust in the currency. The mechanism driving these vulnerabilities is cyclical and predictable. Rising government debt demands increased credit creation, which erodes the currency's real value over time. International actors then respond by reallocating reserves into safer or more stable alternatives, accelerating currency depreciation once key thresholds are crossed. Reserve currency status is not eternal. It relies on credibility, liquidity, and geopolitical alignment. While the US dollar was cemented as the dominant reserve currency after World War II, every historical precedent, from the British pound to the French franc, demonstrates that sustained overextension inevitably triggers decline. Weimar Germany from 1921 to 1923 illustrates the catastrophic effects of unrestrained monetary expansion, where war reparations and excessive debt caused the Reichsmark to lose value by the hour. Prices doubled almost daily, savings evaporated, and social unrest surged, revealing the destructive potential of debt-fueled monetary overreach. Argentina's crisis from 1998 to 2002 presents a modern parallel, where a rigid currency peg, mounting debt, and banking system fragility culminated in the collapse of nearly a third of GDP. The peso's implosion triggered mass unemployment, capital flight, and a $132 billion sovereign debt restructuring, exemplifying how debt overhang and currency rigidity can devastate modern economies. Japan's decades-long stagnation following the 1990 asset bubble demonstrates another structural pattern. High sovereign debt relative to GDP can maintain apparent stability temporarily, but prolonged low growth, deflation, and fiscal inflexibility gradually erode investor confidence. Historical cases consistently reveal that no economy is immune to the pressures of unsustainable debt and imprudent monetary policy. The U.S. now faces similar structural pressures with annual deficits exceeding $2 trillion, while the Federal Reserve holds trillions in Treasury securities. The interplay of heavy borrowing, quantitative easing, and historically low real yields mirrors preconditions observed in prior reserve currency adjustments, though dollar dominance masks early warning signals. Emerging trends show foreign governments diversifying away from dollar reserves due to geopolitical tensions, trade imbalances, and strategic considerations. Russia, China, and other nations have reduced dollar holdings in favor of euros, yuan, and gold, revealing a gradual erosion of the dollar's exclusive role in global finance. Dollar-denominated global debt now exceeds $50 trillion, creating systemic exposure for many emerging economies. Even minor fluctuations in the dollar can magnify debt service costs abroad, triggering defaults, capital flight, and financial contagion, echoing the interconnected dynamics of past crises. The Federal Reserve's aggressive monetary interventions have stabilized markets in the short term, but increased long-term systemic risk. Excess liquidity inflates asset prices while diminishing real returns on savings, subtly undermining confidence in the dollar as a stable store of value both domestically and internationally. Global trade increasingly occurs in non-dollar currencies, with bilateral agreements between China and Europe bypassing the US dollar. This gradual decoupling is consistent with historical patterns in which market participants anticipate structural weaknesses before official acknowledgement, foreshadowing potential disruptions. Fiscal expansion continues despite these risks, driven by entitlement obligations, defense spending, and infrastructure programs. As debt accumulates, each additional dollar borrowed raises inflationary pressure and constrains the government's ability to respond effectively to future economic shocks. Sovereign debt accumulation triggers a self-reinforcing cycle. High debt demands higher issuance, which requires more monetary accommodation, further eroding confidence. This cycle was evident in the British pound collapse after World War I and parallels the current trajectory of U.S. financial policy. Investors historically diversify away from weakening currencies, moving into hard assets or alternative reserve currencies. The dollar's privilege delays adjustment, but the pattern of slow erosion is measurable and increasingly apparent in global reserve allocation. Treasury yields remain historically low, yet inflation expectations are rising, producing a divergence that signals future instability. Historical currency crises show similar conditions where artificially suppressed rates mask structural vulnerabilities until tipping points provoke rapid market correction. Emerging markets are particularly sensitive to dollar fluctuations due to dollar-denominated debt exposure. Strengthening of the dollar increases debt service costs, triggering defaults, capital flight, and broader financial contagion across borders, highlighting the interconnected global financial system. The dollar's central role in commodities, particularly oil, reinforces dominance but amplifies vulnerabilities. Any reduction in confidence can create global commodity volatility, further intensifying inflationary or deflationary pressures worldwide. The trajectory of U.S. national debt now surpasses levels that historically preceded major adjustments in other reserve currency economies. Once debt reaches these thresholds without credible fiscal consolidation, market confidence erodes, and financial mechanisms begin to adjust violently. Central bank treasury holdings have plateaued in some regions, signaling diminished marginal demand for dollar assets. China holds $870 billion, Japan over $1.1 trillion, and shifts in these holdings could destabilize the dollar unexpectedly. Quantitative easing has expanded the Fed's balance sheet from $900 billion in 2008 to over $9 trillion today. While it prevented immediate deflation, it also diluted currency credibility, echoing patterns from historical monetary overexpansion. Digital currencies and central bank digital initiatives introduce potential competitors to the dollar's settlement role. Although adoption is gradual, technological and geopolitical forces could accelerate diversification away from traditional reserve currencies. The relationship between U.S. debt and global confidence is clear. Sustained deficits undermine trust in the dollar over time. Every historical precedent demonstrates that excessive debt, when combined with low interest rates, triggers currency adjustments in global markets. Persistent trade imbalances exacerbate this risk, as the U.S. imports far more than it exports, relying on foreign capital inflows to fund deficits. A reduction in foreign appetite for dollar-denominated assets could expose vulnerabilities that have been accumulating quietly for decades. Interest rate policy plays a crucial role in maintaining currency trust, yet prolonged negative real yields have distorted incentives. Investors and savers are effectively paying to hold U.S. debt, reducing faith in the dollar's role as a store of value. The historical record is unambiguous. Reserve currencies eventually decline when fiscal and monetary discipline erodes. Britain's post-war experience demonstrates that even global dominance does not prevent financial and currency adjustments. Geopolitical factors also influence currency perception, as confidence depends not only on economic strength but also on global influence. Shifts in alliances, trade partnerships, and global sentiment can accelerate the diversification away from a dominant currency. U.S. inflation has remained historically low but is increasingly volatile due to supply chain shocks and fiscal expansion. If unchecked, these pressures could erode the dollar's purchasing power globally, mirroring patterns from previous currency crises. The dollar's strength is a double-edged sword, attracting capital inflows while masking internal vulnerabilities. History shows that overconfidence in currency dominance often precedes sudden and severe market corrections. Emerging alternatives, such as the Chinese yuan, benefit from state-backed infrastructure and global trade integration. Central banks are diversifying, reflecting a gradual recalibration of the global financial system that may accelerate if structural imbalances persist. Federal fiscal obligations are rising faster than revenues, creating a structural deficit problem. Without reforms, debt service will consume an increasing portion of government resources, reducing flexibility in addressing shocks. Global confidence in U.S. treasuries is now contingent on perceived political stability. Any erosion of this perception could prompt rapid shifts in capital allocation, echoing the dynamics of past sovereign debt crises. The Federal Reserve faces a dilemma. Raising rates could stabilize the dollar but increase domestic borrowing costs, while maintaining low rates encourages debt accumulation and inflation. This tension mirrors historical monetary policy challenges that preceded major currency transitions. Investors are increasingly sensitive to credit risk in U.S. debt instruments, despite historically low default probability. Even subtle signs of fiscal stress can trigger portfolio reallocation, increasing market volatility. The U.S. dollar's role as global settlement currency underpins its dominance but creates vulnerabilities in the event of policy missteps. A sudden loss of confidence could reverberate across international trade, commodities, and capital markets. Financial leverage in both public and private sectors amplifies systemic risk. Historical crises demonstrate that high leverage magnifies the impact of currency fluctuations and fiscal imbalances. Emerging market exposure to the dollar is extensive, particularly in debt financing and trade settlements. This interconnection ensures that U.S. monetary policy has far-reaching global consequences, making dollar stability essential to the international economy. Currency hedging is becoming more prominent among multinational corporations and central banks. These strategies reflect early recognition of dollar risks, echoing historical patterns where market participants anticipate structural weaknesses. Persistent federal deficits weaken the dollar's long-term credibility, even in the presence of global demand for safe assets. Historical patterns suggest that sustained fiscal imbalance is incompatible with enduring currency dominance. Inflation dynamics remain complex, as global supply chain shifts interact with domestic monetary expansion. These pressures can reduce purchasing power and weaken confidence, particularly among foreign investors in dollar-denominated assets. The dollar's historical track record as a safe haven masks accumulating structural risk. Every major reserve currency in history has eventually experienced a period of erosion, often accelerated by debt and fiscal imbalances. High U.S. corporate and government leverage increases exposure to shifts in interest rates and inflation. Historical crises illustrate that when debt burdens become unsustainable, currency and financial instability quickly follow. Global reserve diversification is increasing at a slow but steady pace. Euros, yuan, and digital assets are now being held as part of official foreign exchange reserves, demonstrating a measured reassessment of dollar dependency. Trade imbalances are widening, with the U.S. running persistent deficits while relying on capital inflows to finance them. Any disruption in foreign investment patterns could expose structural vulnerabilities in the currency system. The Federal Reserve's balance sheet expansion has created unprecedented liquidity, but also raised concerns about long-term stability. Monetary accommodation masks underlying fiscal weaknesses, echoing historical periods where currency trust was gradually undermined before collapse.